Financial collapses do not begin with panic. They begin with silence. No alarms, no headlines, no sudden crashes, just hesitation. A trade that doesn't happen. A loan that isn't rolled. A market that pauses briefly before moving on. Most people never notice this moment. But this is where every modern crisis begins. Because in today's system, collapse doesn't arrive like an explosion. It arrives like evaporation. And once confidence begins to disappear, nothing can force it back. Why confidence is everything. Money today is not backed by gold. It is not constrained by reserves, and it is not limited by law. It is backed by belief. Belief that markets will function tomorrow, liquidity will be available when needed, promises will be honored, someone will step in if things go wrong. As long as this belief holds, the system feels solid. But confidence is not logical. It is reflexive. It feeds on itself until it doesn't. Confidence vs. solvency. In old financial systems, collapse happened when institutions became insolvent. They ran out of money. In modern systems, collapse happens when institutions become illiquid. They still own assets. They still appear solvent on paper, but they cannot convert those assets into cash fast enough. And when liquidity vanishes, solvency becomes irrelevant. This is the critical distinction most people miss. The first crack, funding hesitation. The earliest sign of confidence breaking is not loss. It is hesitation. A lender asks for better collateral. A fund shortens loan terms. A market demands a slightly higher premium. Nothing dramatic, but these small adjustments ripple outward. Leverage tightens, positions shrink, risk hides. The system does not collapse here, it contracts. When liquidity pulls back, liquidity is not permanent. It exists only as long as participants believe they can exit positions easily. When that belief weakens, repo haircuts rise, funding costs increase, short-term lending slows. This is where confidence turns inward. Institutions stop trusting the market and start protecting themselves. This behavior is rational, and it is contagious. The speed problem. Modern finance moves at machine speed. Algorithms respond instantly. Funds rebalance automatically. Risk models update continuously. This means confidence doesn't fade gradually. It flips. What once looked stable suddenly looks fragile. And because leverage is layered across the system, small shocks propagate rapidly. This is why modern crises feel sudden even though they are months in the making. The illusion of diversification. One of the great myths of modern finance is diversification. Assets appear spread across funds, institutions, regions, instruments, but diversification only works when liquidity exists everywhere. When confidence breaks, correlations rise, everyone tries to exit at once, and suddenly, everything is connected. Margin calls, the system's nervous system. As prices fall and volatility rises, margin calls appear. They are not judgments, they are automatic. Collateral values drop, requirements increase, positions must be reduced. This forces selling not because assets are worthless but because funding has tightened. This is how financial stress becomes mechanical. No villain, no decision, just math. Why central banks step in. When confidence collapses, central banks intervene, not to save investors, not to protect markets, but to restore function. They provide liquidity because payment systems must operate, credit markets must clear, confidence must be stabilized, but central banks cannot force trust. They can only replace it temporarily. The limits of intervention. Every intervention works until it doesn't. Liquidity can delay collapse, it can soften impact, it can buy time, but it cannot repair belief permanently, because belief is not injected, it is earned. And once participants question the system's stability, their behavior changes, often forever. The distribution of pain. When confidence breaks, losses do not spread evenly, they concentrate. Those closest to liquidity recover first, those furthest away absorb damage. This is why crises increase inequality, not by design but by structure. The slow aftermath. After the panic fades, something remains broken. Risk appetite changes, capital retreats, growth slows, the system survives but tighter. This is the hidden cost of confidence loss. It does not destroy the system, it reshapes it. Why people misread crises. Most people misunderstand financial crises because they focus on symptoms, falling markets, rising unemployment, government action. But these are consequences. The real event happens earlier, when confidence quietly withdraws. By the time panic is visible, the outcome is already set. Why this keeps happening. Confidence-based systems are powerful. They scale rapidly, they adapt quickly, they unlock enormous growth, but they are inherently cyclical. Because confidence expands faster than caution, and contracts faster than logic. This is not a flaw, it is the cost of speed. Can the system be fixed? Some ask if regulation can prevent this. Others suggest better oversight. But confidence cannot be regulated. You cannot legislate belief, you can only influence incentives. And incentives always push toward expansion until they don't. The future of financial stability. Future crises will not look like past ones. They will not center on banks. They will not begin with defaults. They will emerge through liquidity mismatches, confidence shocks, structural stress, and they will be explained only after the fact. The role of the individual. Most individuals feel powerless in these systems. But understanding changes perception. You may not control markets, but you can recognize patterns. And recognizing patterns removes surprise. The final paradox: if this changed the way you see the modern financial system, so like, share and subscribe to it. The modern financial system survives because people believe it will, and it fails temporarily when they don't. This makes confidence both its foundation and its vulnerability. What confidence really is: confidence is not optimism. It is not hope. It is a collective agreement to continue, to roll obligations forward, to trust prices, to assume tomorrow resembles today. When that agreement breaks, nothing forces it back together. So what happens when confidence breaks? Liquidity disappears, leverage reverses, and systems reveal their true shape, not through collapse but through contraction. The system survives, but not unchanged, because once belief is shaken, it never returns in the same form, and that is the real cost of modern finance. Money today is not controlled by banks, not by governments, and not by laws alone. It is controlled by confidence. And confidence is the one thing no system can command. The system didn't fail. It revealed itself.